All right, welcome to The Explainer. Today, we're digging into the absolute breakdown in compliance that linked a global banking giant to one of the most infamous predators of our time. It's a story about blindingly obvious warnings that were ignored, policies that were completely broken, and just staggering amounts of money. So what's this number? This is the massive fine that New York regulators just slammed Deutsche Bank with. The reason? Significant compliance failures tied to its business with Jeffrey Epstein. And get this, it was the very first time any financial institution was actually penalized for their relationship with him.
And then there's this number. This is what the bank had to pay to settle a truly groundbreaking lawsuit. It was brought by Epstein's victims, and their argument was that the bank knew what was going on and actually benefited from his sex trafficking ring.
So you see these incredible numbers, and it just begs the question, right? How in the world did a massive, sophisticated global bank let this happen? Not for a month, not for a year, but for 5 long years. Okay, so here's how we're going to break this all down. We're going to look at how this toxic relationship even got started, the trail of red flags that were just completely ignored, the systemic breakdown that let it all continue, and of course, the incredibly costly fallout. So let's start right there with the fallout. We're talking hundreds of millions of dollars out the door, and a stain on the reputation that, well, you just can't wash that away. So how did this all begin? I mean, where did it go so wrong? To understand that, we have to rewind back to 2013, to what regulators later called the original sin, the decision to even take on Jeffrey Epstein as a client in the first place. Now let's be super clear here. This was not a case of the bank not knowing. Epstein's conviction for soliciting a minor was public record for 6 years before Deutsche Bank ever opened an account for him. They knew exactly who they were getting into business with. And this, right here, this really gets to the heart of the problem. On one side, you have the promise of millions of dollars in revenue every year. And on the other, you have a client whose criminal record was basically a giant flashing neon red light for reputational and legal risk. So how'd they do it? How'd they justify it? Well, they just bent their own rules. Instead of the formal risk review they were supposed to do, the whole thing was approved based on what regulators called an offhand conversation that was just noted in an email. That one informal email, that became the green light for opening more than 40 different accounts for Epstein. Okay, so the doors are now wide open, and it did not take long for the money to start moving in some really disturbing ways. A pattern of suspicious activity popped up almost immediately. I mean, just look at this. Epstein was using his accounts to send millions to his alleged co-conspirators from his criminal case, to women with Eastern European last names, and for a constant stream of legal fees. He even had this thing called the Butterfly Trust to pay rent and tuition for a bunch of women. Every single one of these should have been a massive, blaring alarm bell. You know, one of the most obvious red flags was a classic money laundering trick called structuring. Basically, it's when you intentionally break up big cash transactions into smaller ones, specifically to stay under that $10,000 limit that automatically gets reported to the government. And if you want to talk about intent, I mean, this is just, wow. It could not be more deliberate. According to the regulators, Epstein's own lawyer walked into a branch, flat out asked a teller how to avoid triggering a report, and then did exactly that, split a big withdrawal into smaller pieces over a couple of days. And get this, it wasn't just a one-time thing. Not even close. Over a 4-year period, that same lawyer pulled out more than $800,000 in cash, a lot of it in these carefully structured amounts. And the bank's own employees were the ones who'd been asked how to get around the rules. Look, it's easy to think this was just a few people dropping the ball, but no, the evidence points to a complete and total systemic breakdown of the bank's own internal compliance systems. Just take a look at the bank's own risk committee. They eventually put some conditions on the relationship, but those rules were either totally misunderstood, never even told to the people on the front lines, or just completely ignored when senior managers simply took Epstein at his word after a meeting at his house. And that misinterpretation, it had real, devastating consequences. An alert for a payment to a Russian model was just dismissed. And the note on the file says it all. The activity was considered normal for this client. Think about that. The bank effectively normalized deeply suspicious activity just for him. And listen, this wasn't just a failure from the top. People on the ground saw what was happening.
A whistleblower, who used to be an anti-money laundering officer, told the FBI that her whole team wanted to cut ties with Epstein, but management shut them down, supposedly saying that Epstein had already served his time. Well, eventually the bill comes due, right? After years of enabling this kind of behavior, the bank finally had to face a massive financial and legal reckoning. So what did that look like? Well, first, a massive $150 million fine from regulators for their compliance failures. And on top of that, a $75 million settlement paid directly to the women victimized by Epstein, a settlement that lawyers called absolutely groundbreaking. And that regulatory fine, that was a huge deal. It set this powerful new precedent, making it crystal clear that banks can and will be held responsible for the role they play in helping their criminal clients move money around. So after all of that, what's the big takeaway from this whole catastrophe? The lessons here are pretty stark, and honestly, they're crucial for the entire financial industry. The bottom line is that banks have to connect the dots. You simply cannot ignore a client's criminal history when you see financial transactions that look exactly like that criminal behavior. Your internal policies mean nothing if people don't know about them, and you can't just take a client's word for it when all the red flags are waving. And this whole saga, it really leaves us with one big, uncomfortable question. It perfectly shows this constant battle between making a profit and following procedures. It just forces us to ask, when a client is promising to bring in millions of dollars, can a bank's internal safety nets ever really be strong enough to overcome the pressure to just look the other way?